You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
Happy New Year and welcome to 2023. I'm Kathy Fettke and welcome to The RealWealth Show. Today I'm going to do my best to forecast what we can expect in real estate this year in 2023. So I thought I would invite somebody who knows a lot about the topic, Rick Sharga, VP of ATTOM Data Solutions. If you don't know Rick, you should. He's one of the country's most frequently quoted sources on real estate, mortgage, and foreclosure trends. He's appeared on CNBC, CBS News, NBC, CNN, ABC, Fox, Bloomberg, and of course today on The RealWealth Show again. So Rick, thank you so much for being here and welcome back.
Thank you for having me again.
I hope you're armed and ready with lots of great data.
We'll give it our best shot.
Okay, so many questions. Happy New Year. Welcome to 2023. What's your outlook for 2023? Are you positive? Are you nervous? What are your thoughts?
I'm positive it's not going to be a banner year for real estate. How's that?
That is exactly the answer I expected.
No, I don't think it's going to be a disaster, but I do think there's going to be some lingering weakness in the residential real estate market. Although there are parts of the country that will actually do really well. And I do think we're starting to see a downturn in various segments in the commercial market as well. Sort of the long COVID impact on some of the commercial markets. But yeah, it'll be a challenging year, but not a disaster.
Long haul COVID on commercial real estate. Yeah. Well, so many things that you just said there. I'm going to just dive into the first one that I know that our listeners are wondering what your answer is. You said some areas will do very well. Which areas?
So I'm looking at the southeastern part of the country, states like the Carolinas, Tennessee, Florida, surprisingly enough, states like Alabama, parts of Texas. So the South and Southeast, I believe, will continue to see growth. And that's due largely to two things, population growth. We're still seeing a lot of people moving into those states and job growth. So those two indicators tend to be pretty good predictors of home sales as well. So, at ATTOM, we're looking at home prices probably going down about 5% this year nationally. But that means some markets like coastal California, you could see 10, 15% declines in prices. Some of these other markets, you're actually going to see prices go up. So it's going to be a very localized sort of correction in the residential market this year. And again, I think states in the South and Southeast are probably poised to do the best.
Well, you're speaking my language. I mean, these are the areas that we've been focused on for a decade. So they seem to be very resilient. And here we are again, in a questionable time. Would you say that people are still migrating to these areas and that there is still job growth in those areas?
Yeah, by and large, yeah, I think that's fair to say. There was a recent report out from U-Haul, their annual one-way truck rental conversation, and states like Texas, states like the Carolinas, all had net increases in people renting U-Hauls and moving in, whereas states like California, New York, Illinois, Michigan, Massachusetts had more people leaving with U-Hauls than coming into the state. So I do think we're continuing to see that kind of migration that tends to come along with job growth. And I think the wave that we had after the pandemic was declared, where we saw large numbers of people moving out of high price, high cost, high tax states into markets where they could afford to buy a house or a bigger house. I think those large numbers have probably settled down, but I think you'll still see a trickle effect from even the work from home aspect of the pandemic.
Well, and the millennials have been getting so much attention for being able to work remotely and, having pretty good salaries, not all of them, but enough that have been buying real estate. Yeah. But there's also the baby boomers, a forgotten generation that's also very big. And whatever the baby boomers have done in the past, it usually affected housing or the economy or the stock market. And many baby boomers are retiring. Do you think that has anything to do with this migration pattern of people moving to more affordable places with better climates?
Absolutely. Or even just more affordable places, even with questionable climates. The boomers had been largely responsible for the average tenure of home ownership going up pretty significantly. So that generation has opted to age in place at much higher numbers than prior generations did. So they're living longer, they're staying healthier, they're staying in their homes. So a decade ago, the average time somebody spent in a house after they bought it was 5 to 7 years. And about a year ago, that number was up to 12 years. And that was largely because boomers had stayed put. And that, by the way, was one of the reasons why we saw less inventory than we expected, excuse me, in the existing home market. Now we're starting to see boomers move out. And I will guarantee you, if you parse the data of people moving from California and New York, you're going to see a lot of boomers moving out simply because they're not sure they can afford to stay in those states based on what they have available in retirement income. And we know for decades, Florida has been a haven for New York retirees because of lower costs and better weather. And I suspect we're seeing that more broadly across the country right now.
Well, and it seems like as people age, they maybe become more conservative as well. They might be liking the conservative policies of those states. I mean, I don't know if you have any data on that, but
you're going to actually ask me to talk red state versus blue state.
Yeah, maybe.
No, that's I don't have any data on that, but surveys show that is one of the reasons people are moving. And by the way, that works both ways. There are also people leaving red states because they're looking to be somewhere a little bit more progressive. That certainly, we saw a little bit of a blip in that activity after the Supreme Court reversed Roe versus Wade. People moving from red states to blue states. But I do suspect, to your point, as people get older, they do tend to get more conservative and might be looking for a more conservative environment to retire into.
And with that said, I'm going to throw that all out the window because, you just look at Miami, where so many New York businesses, especially in the financial industry, are moving to Miami. And I wouldn't imagine they're all conservative, but maybe they like.
If you're going to look at New York City businesses, the financial businesses are going to tend to be the most conservative ones there. So, but Miami is a great case in point because Miami is probably as close to an international city as we have in the United States. You have a lot of immigrants coming in from South America, from Central America, from other parts of the world, and it is a very, very eclectic city in terms of culture and environment. So, so Florida tends to look more and more these days as a somewhat conservative state, but I'm not sure you can really say that about Miami.
Miami would be purple then. It would just be a big blend. All right. So that was the positive. I just, of course, that popped out when on your opening statement that there were some areas that were going to do better. On the flip side, what areas would you be more cautious of in 2023?
Yeah, we already mentioned a few of them. So I think coastal California is probably going to see some weakness in terms of both volume of sales and prices. Pacific Northwest probably is going to take a little bit of a hit. We're already seeing that. Portland, Seattle markets relatively weak from a pricing perspective. Illinois and New York probably not going to have banner years for residential home sales. And then there's some just kind of individual markets. Austin comes to mind as a market that may have got out beyond rational pricing over the last couple of years, may have some clawback. Phoenix, Las Vegas are markets where we've seen 50% price gains over the last couple of years. Might be some pullback in some of those markets. And then I'd also, we were talking about this earlier, I would take a look at some of the so-called Zoom towns. So the markets which came out of nowhere, so, St. George, Utah, Boise, Idaho, where you saw, annual price increases of 47%, which is just crazy. as people moved out of higher cost states for a better standard of living. So I think there might be a little bit of pullback in some of those markets as prices kind of rationalize.
But this is my opinion on it. Those are pretty attractive areas. That's why they boomed. And so if you were thinking of retiring one of those places, this could be the time because there's a lot more inventory. It's probably shifting to a buyer's market in those markets.
It's probably a little premature to go to buyer's market, but it's definitely a more balanced market. So you're not going to see 30 people bidding on a property, and so that would tend to make it a little bit more favorable to buyers. I still think there's not enough inventory, even in markets like those, that are attractive markets for out-of-state people to move to swing the market from seller to buyer. But it's more balanced for sure. And I think that's probably something safe to say for most of the country in 2023 is it'll be a much more balanced market than it has been for the last couple of years when it was clearly one of the strongest sellers markets probably in history.
Yeah, so I guess I'm just saying for those who are afraid of dipping their toes into the water, but wanted to be in those popular markets, this could really be the time because there is.
Look, Kathy, I have two adult kids. We've talked about this before, and the median sale price of a property in California is still around $800,000, and there's no way somebody just coming out of college is going to be able to buy a house there. So even if you are looking at property values that dramatically inflated in some of these mid-tier markets, they're still going to be wildly more affordable. Excuse me, than in some markets like California and New York. So even at higher prices, even with the threat of those prices maybe coming back a little bit after you've purchased a property, still much more affordable, still much better value represented in buying homes in some of those markets than in some of the more established markets.
Yeah. So bottom line, don't be afraid. This could be the buying opportunity of a lifetime, not of a lifetime, but a good buying opportunity if you want to be in those markets. Those aren't markets that we invest in because of the volatility we like the good old Southeast, like you mentioned, and some of the Midwest markets that just kind of stay stable through these recessions and these highs and these lows. Although Cleveland and Cincinnati have been some cash flow markets for us that never really have gone up in value. And boy, those areas went up in value quite a bit as well. I think Cincinnati was seeing 25% price gains at one point, which is really unusual for them.
Well, Columbus, Ohio has probably been one of the most under the radar hot markets really for the last number of years. And it has a lot of things going for it in terms of, strong medical industry presence, university town, and reasonable cost of living. There are markets like that. And to your point, if you're looking at properties as an investor as opposed to a homeowner, there's nothing wrong with Midwestern cities. Indianapolis, I know investors who, were traditionally getting 18% cash on cash returns every year. Now, home price appreciation was negligible, almost no appreciation for a long time. But if you're looking at a buy and hold strategy and making your money on cash flow, a lot of those Midwestern cities represent really good deals.
Absolutely. Yep. They always have. And especially if those areas are reinventing themselves and attracting businesses to them, which Indianapolis, like you said, Indianapolis, Kansas City, Birmingham, they've been doing that slow and steady for the past decade.
And Kansas City has great barbecue, by the way. So that too.
I know there was one real estate trip I took where I was in Dallas one day, Kansas City, and what was it? Oh, in Memphis. And I decided, so I was going to be in each of those cities. I was going to test their best barbecue, and Kansas City won for me.
To Kansas City, they won the Kathy Fetke Barbecue Award.
Yeah, it was amazing. And I'd have to go back and test it again because it probably changes every year.
Let me know. That'd be a fun trip.
Yes. Kind of like your dinosaur hunting trips, which I did see on Facebook.
That's my son. And shout out to my son. Worked for a paleontologist in South Dakota, and right before he came back home, uncovered what they believe is the third or fourth largest T-Rex femur ever discovered. It was,
wow!
about a 4.5 foot long thigh bone. So that's something that most people can't put on their resume.
So curious, and this is very off topic, but did you read him a lot of dinosaur books? Like, how do you become? Yes, the answer is yes.
Yeah, we're other people were reading The Three Bears. I was actually reading him excerpts from a dinosaur encyclopedia. He's just always been fixated or fascinated with that stuff. And we would play with dinosaurs, hours on end when he was a little boy. So for his high school graduation trip, I was kind of coerced into fulfilling a promise I made when he was a little boy. And we went out and actually worked for this paleontologist for about a week, went on a legitimate dinosaur dig. And then last year, the paleontologist was looking for some temporary full-time help. My son raised his hand and went out and had that 5-month experience of a lifetime. So I'm really happy he's had a chance to do that.
Well, that is my parental tip for the day. Just let your kids follow their dreams, and it will usually end up somewhere good. Hopefully, if they're good dreams. I mean, I have 2 daughters, so they just wanted to see castles in Europe because they want to be princesses. But, I don't know if they'll make a career out of that.
I doubt my son's going to be a full-time paleontologist. So but it was a fun trip while it was going on.
Oh, that's great. Okay, back to real estate. Commercial real estate. So let me start with, I feel pretty confident, not pretty confident. I feel very confident being a buy and hold rental I feel very confident being a buy and hold rental property investor. With interest rates so high, there's so much demand for rentals. And a lot of people still do prefer single family rentals over living in an apartment. But commercial, let's talk about that. Apartments, commercial. There seems to be some trouble brewing there. What are your thoughts on commercial property in 2023?
Yeah, I don't know that we're seeing a big storm on the horizon, but it's definitely getting a little cloudy. We've seen sales of multifamily units drop pretty significantly. Here in Southern California, where I am today, sales are down about 50% year over year. And it has a lot to do with cap rates. You're looking because the cost of capital has gone up so significantly in the last year. You're looking at cap rates of, 3.5%, where your financing cost is, somewhere in the 6 to 9% range. So it's hard to justify that kind of investment, at least in the short term. There's also, I am led to believe, a record amount of multifamily inventory coming to market in the next 12 to 18 months based on what's currently under construction. We've seen housing start numbers go down by double digits, but we've also seen multifamily starts go up by double digits year over year. So, that's a troubling combination if you're an investor in the multifamily market. I haven't seen similar issues rear their head yet in the single family rental space, but there's a little bit less demand than you might expect for multifamily right now, given that some people have decided not to buy but to rent. And depending on where this new inventory comes to market, you could wind up with vacancy rates ticking up a bit, which then tends to lead to rental rates coming down. So it's definitely a segment to watch. It's been probably the second hottest sector of the commercial market for the last few years, but definitely flattening out a little bit right now.
Yeah, I think there's going to be a huge opportunity in multifamily, but for us, we're going to wait about a year to see where things sort of settle. And in the meantime, the opportunity, in my opinion, is in single family. With that said,
a lot of the people, survey data I've seen shows anywhere from 10 to 20% of people who had planned to buy a house have now opted to wait for a while, just either until they can save more money for a down payment or until interest rates settle. So at least in the short term, that could be a boon for single family rental owners. Because it stands to reason if somebody was looking to buy a house, they might be more inclined to rent one than to rent an apartment. And so that could provide a little bit of a tailwind for the single family rental market as well.
Yeah. And so back to multifamily, you mentioned overbuilding, or I don't know, overbuilding, but lots of building. Are there areas where there may be concern of overbuilding?
I'd be making stuff up right now, Kathy, if I told you I'd done that kind of detailed research.
Hmm.
I just really now started to kind of take a look at multifamily building in general. As it's become apparent that there's an awful lot of inventory getting ready to come to market, we'll probably do a little bit more research into where those properties are coming online. But I'd be making stuff up if I told you I knew which markets were in danger of seeing an oversupply.
Well, I'll tell you what my dream is then. My dream is that we're able to acquire an A-class brand new apartment for less.
And you probably will in the next 12 to 18 months. There are owners looking to exit, um, and there are loans getting ready to reset that the current owners aren't going to be able to handle. So I think there are going to be buying opportunities out there for people who either have cash or have financing ready to go. Um, and where we've seen, interestingly, where we've seen a little bit of pullback on rental rates has tended to be A-class properties, particularly at the higher end. And I do think that probably comes down to something of a supply and demand uh, scenario.
Interesting. Okay, there's a lot of talk about office. Again, I don't know how much data you have on that, but I just know from people I know that they're just getting hammered. Office is a tough place to be right now. What are your thoughts there?
Well, you're at ground zero for the office market not recovering. The San
Mhm.
Francisco market is clearly an outlier in terms of recovering from the pandemic. I've heard stories of vacancy rates being in the high 40% range in the
Wow.
city, in the downtown area, and no indication that it's getting better. And that throws a shadow over other businesses, whether it's smaller offices with companies that typically are around to support the workers in those high rises, restaurants, other service providers. So it really has a kind of ripple effect across the entire economy of a city like San Francisco. New York, we're seeing an extraordinary amount of subleasing going on as people are not coming back to office. So there are some people getting deals on sublease contracts. But for a while after COVID struck, we had kind of a tale of two cities going on. We had suburban office centers growing and seeing prices increase, where we saw central business district vacancy rates going up pretty significantly and prices coming down in terms of sales. Um, Now the whole office market seems to be kind of hung over a little bit. And I believe this, when COVID first struck, one of the things I cautioned people about was not to read too much into current office numbers at the time, because a lot of these building owners were protected by having long-term leases with their tenants. A lot of these leases are coming due now. And in many cases, the tenants are opting not to re-enter into a new lease. They're downsizing. Their whole company is working from home. Things along those lines. So I don't think we've bottomed out yet in the office market nationally, and I think there's probably another year or two where we're going to continue to see kind of the vestiges of the impacts of COVID.
Well, and oftentimes that comes with opportunity. Are you seeing any alternative use for all that office space?
I was on social media talking to somebody about this last night. They were talking about adaptive reuse, turning office buildings into residential units, and how people had said that was impossible before, but now suddenly it seems possible. And I reminded him that about 250 years ago, Ben Franklin was quoted as saying, "Necessity is often the mother of invention." And I think adaptive reuse is a necessity right now. So, yeah, I think we're seeing that kind of reuse in the office space and in the retail space, where you don't need quite as much brick and mortar availability as you used to. So we're seeing a lot of these buildings repurposed into multi-use facilities where there's some combination of retail, restaurants, residential units, and office space. And you're seeing the same thing in the office market as well, particularly in areas where the buildings lend themselves to being converted to residential. It's tough to do very often in a downtown building, just because there are zoning requirements that are very often difficult to get around. And sometimes just the way the buildings are constructed, it would make for really oddly shaped living quarters. But there was just a story about a building, I believe was in Hudson Yards in New York, that's being completely redone as a residential building. So yeah, I think we're going to see more of that in the years to come.
Yeah, I would think so. If it's mixed use, you got to be careful. When I lived in San Francisco and I went to San Francisco State, we lived above a pizza place, which was great at 2 a.m., when we would come home from the party scene. But it was really awful at like 6 a.m. to be smelling pizza.
I actually, you and I have that in common. Actually, when I was in college, I lived in an apartment over a pizza shop as well. And for some reason, I always woke up hungry.
It's true. I ate a lot of pizza, but I was in my 20s, so I could. All right. Let's see. What else? The debt crisis in commercial. I know on my other podcast with Bigger Pockets on the Market, we interviewed, and someone from Fundrise on the topic, and he was really concerned that there's just not the liquidity. Do you have any thoughts on the liquidity in the commercial market? Like, are people going to be able to refi their commercial property?
I think we're going to see a lot of owners need to get out from under their financing as these loans come due. I remember back during the Great Recession, there was this long rumored wall of liquidity that was going to crumble in the MBS market, in the commercial mortgage-backed securities market. And it never really came to pass. So what I've seen historically in commercial markets is an extraordinary amount of creativity about loan workouts. And we all know that there's a lot of capital on the sidelines right now, waiting to kind of swoop in and take advantage of whatever distress there is in the market. So I don't know if there's going to be a debt crisis in terms of enormous fallout, but I do think we're definitely going to have some winners and losers as a lot of these loans come due, and there will be probably a fairly large number of owners who simply are going to have to exit the business one way or the other when the time comes.
Yeah, I hadn't really thought about that. There's so many huge firms starting new funds ready to pick up that, all that commercial real estate. So hopefully they'll leave some of it for the little guys.
I think especially if you're looking at low dollar commercial properties,
Mm-hmm.
there are going to be a lot of buying opportunities. I expected the hotel segment to crater. I mean, just crater after COVID. And we're still seeing occupancy rates at hotels below where they were in 2019, almost 4 years later. But what instead we saw was a lot of sales activity. Sales activity spiked in the hotel sector. And I'm led to believe that's because we saw a lot of limited service hotels change hands. Those hotels, think, Hilton Garden Inn and Marriott Fairfield Inn, those kind of hotels, are very often owned by small investors. And in a lot of cases, they simply didn't have the financial wherewithal to get through 2-3 years of below normal levels of occupancy. But rather than lose these properties to foreclosure, they sold them. So we saw a spike in hotel sales over the last couple of years, and I think that's been other small to mid-sized investors swooping in and taking these properties off the previous owner's hands. So I think there'll be a lot of that in the low dollar figures. Those big institutional investment funds that we see tend not to be interested in the sub $1 million or sub $2 million assets. So I think for small investors, for individual investors, there's going to be a lot of those assets available and ready for the taking.
Okay, and final question. You got to pull out your crystal ball on this one and tell me exactly what the Fed is going to do in 2023.
God, if I'd known that last year, I'd be on my book tour right now, and we'd do that barbecue swing through the Midwest. I am probably in the minority here. Hopeful that if we get one or two more good reports on inflation, the Fed will scale back significantly on the aggressive tack it's taken in raising rates for the last 6 or 7 months. On the residential side, there's already room for rates to come down if we just got back to a normal spread between the yield on the 10-year U.S. Treasury and the interest rates on 30-year fixed rate loans. There's about 100 extra basis points, a full percentage point difference between normal spreads and where we are today. So if the Fed just announced it was going to scale back or not be terribly aggressive and the markets could settle down a little bit, we could see rates come down. I think the Fed acknowledges at this point that if they continue to be aggressive, they are going to steer us into a recession. I know they'd prefer not to do that if they can avoid it. But where do I think Fed funds rates will cap out? I don't really know. I'm hoping they don't cap out much higher than 5, maybe even a little bit less than that. But it really is a coin toss right now. They're hard to predict, and they've warned us that they're aware that what they're doing could lead to a recession. I guess the only good news is if they do steer us into a recession, odds are that rates will come down. So we at least have that to look forward to. But that was a long-winded answer to tell you I have no idea what the Fed's going to do.
I figured that, but they're warning us still that they're going to get to the 5s, right? Is that what they're still saying?
No, they haven't said that.
Okay.
People that analyze what they say are now predicting we'll be in the 5.25 range as opposed to 4.5 or 4.75, which was the last speculation. What the Fed has said is they expect unemployment to be up in the 4.5-ish range by the end of this year, which is a little higher than what they'd expected before. But by the way, still lower than what some of the economists I follow are projecting, which is unemployment rates in the 5s. What I will tell you is my personal research historically has shown that the inflection point for home sales tends to be around 6% unemployment. So if unemployment does peak in the 5s and doesn't cross that 6 barrier, at least we'll have that going for us from a home sales perspective.
Okay, so it's kind of a wait and see and just know that we don't know where we're going to land. But right now, it sounds like you're not really expecting a deep recession or even a recession in 2023, or did I get it?
I'm inclined to believe we will have a recession. We've had a huge yield curve inversion that's been going on for quite a while right now. The last 7 times that's happened, we've had a recession. And every time the Fed has raised the Fed funds rate in order to combat inflation, going back as far as World War II, about 80% of the time that's led to a recession as well. What I'm hopeful about, and what a lot of the economists whose work I follow are saying, is that because all the other aspects of the economy are actually pretty strong right now, if we do enter a recession, it'll be strictly because of Fed policy. And because of that, hopefully the recession would be relatively mild and relatively short. So that's kind of my outlook for 2023 as well.
Oh, very good. All right. I'll take that as a positive.
I do as well, honestly.
Yeah. Okay, wonderful. Rick Sharga, it's always such a pleasure to have you here, and I always learn so much. Thank you. Thank you for being here.
Thanks so much, Kathy. Happy New Year.
Happy New Year to you. And thank you for joining me here on The Real Wealth Show. You can go to realwealthshow.com to get more information on best markets and market data and referrals to teams in those markets who can help you with property management or acquiring rental property in the strongest rental and growth markets in the U.S. Again, that's realwealthshow.com.
Views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.